Stories in the news, buybacks. A lot of discussions about buybacks, some proposals in the Congress that perhaps limit tax benefits from buybacks. Has the SEC looked at this at all? How do you view the role of buybacks in the market, and are they a help to the marketplace?
Well, why don't we separate those two into what buybacks are used for and then the regulation of market activity around buybacks. So buybacks are a capital allocation tool. It's a tool that boards of directors, managers use to allocate capital. If they think capital should be returned to shareholders, oftentimes a buyback is the most efficient way to do it. Now, once they choose to do a buyback, it's our job to make sure that buybacks and other market activities are done fairly. And we have rules around how people can conduct buybacks to ensure that there's not manipulation.
There's nothing wrong with them per se, though. There seem to be implications that they're un-American in some way, that they hurt the economy, that benefits just rich people. There's a reason for buybacks, and does the SEC understand that?
Well, buybacks are a capital allocation mechanism. If you have too much cash and you don't have a good use for it, one thing to do is to return it to shareholders. We do have the banks regulate whether a bank can buy back stock or not for capital adequacy and things like that. But inherently, a buyback is a capital allocation tool.
Brett, a similar question to you, except this time it's on proposals to tax stock trading. In Congress, we've seen some proposals in the last few weeks to bring back a tax on stock trading, 0.1%. We've tried this in other parts of the world. What is the SEC position on this? Is there one? And would it help investors? Would it raise money? Would it be bad for the markets? Your thoughts?
I think we still need to look at what are the details of this proposal and learn a little bit more about it. But in the meantime, I think the concerns would be whether or not a tax like that would ultimately find its way back to investors. And to the extent that it was creating frictions in the market for market makers and then finding its way back to investors and simply taking away from the returns of the savings of all the investors out there, then that would probably be the area where we would have some concerns.
Yeah, we'll have more on that a little bit later this hour. Mr. Chairman, I wanted to ask you about the proliferation that we've seen of stock exchanges. There are plans now to launch a Miami exchange, plans to launch members exchange. We know about the long-term stock exchange that may be coming, and all of these exchanges, of course, can be viable because brokers have to pay to link up to them, and then they can charge as part of the data feed. My question to you is having 16 stock exchanges, if we get to that point, good for U.S. financial markets, or does it actually undermine their efficacy?
Well, Kelly, the question about number of exchanges and the optimal number of exchanges is something that we think about, and it's unlikely that one size fits all. For very liquid stocks, multiple exchanges, we think that is inured to the benefit of long-term investors. When you get into more thinly traded stocks, the question of multiple venues is a really good one. And whether for thinly traded stocks, we would have more optimal trading for long-term investors by concentrating trading in one venue. That's a question that we're asking. It's one of the things that Brett and I talked about at Fordham today, and we're looking for public comment around this issue.
Because it does sound like by forcing people, the SEC regulation is, look, brokers, and this makes sense, they have to execute at the best price, but that means they have to be linked up to all of these exchanges. Would you guys look at relaxing that or exempting it for people who are trying to serve the individual investor, for example? Is there a way to kind of siphon out activity so that it's not raising the cost of trading for everybody because there's so many different players involved?
Yeah, Kelly, you're asking exactly the right question. The multiple players we have today, I would say the majority of participants who look at this feel pretty comfortable that at the highly liquid end of the spectrum, that's working well for investors. We have real questions about whether down at the illiquid end of the spectrum, those multiple venues, multiple exchanges are working well for investors.
Two quick questions for you. Number one, we've seen the markets down on concerns about global growth. You have spoken in the past about your concern about the effect of Brexit on U.S. corporations. Can you explain to us what your concerns are? And secondly, on a different topic, I want to ask you about the Bitcoin ETF. There's some coming up for your consideration. It's been quiet for a while, but maybe you can update on that. Two quick questions.
Sure. On Brexit, look, we've asked our issuers to tell their investors, hey, what are you doing to plan for Brexit? Now, Brexit is 3 weeks away in terms of the current deadline. Brexit's already here in the boardroom. People are already making decisions. They're making hiring decisions. They're making capital allocation decisions. And they're doing it against a range of outcomes. But it's happening. So I think we're already seeing the effects of Brexit in the way companies are behaving, and therefore in the marketplace. I mean, the marketplace reflects companies' behavior. So Bitcoin ETF, I really don't have a lot to say about that here, Bob. You know, we are going through processes for people who make applications to us. I've said what makes me uncomfortable in the past. You got to be able to custody something really well, and you got to be able to know that the trading in the underlier is something that a retail customer can think is reliable. I have concerns, and I still have concerns in both those areas.
I want to ask you about it. I know it's a sensitive subject, but I want to ask about Elon Musk. You filed a complaint alleging he violated the terms of the agreement with a series of tweets. Can you bring us up to date on where that process is? Can you educate us a little bit more about what's happening with this process?
So look, I'm not going to comment on conduct or any specific enforcement action. It's inappropriate. Where this one stands is the judge has asked for Mr. Musk to show whether he has complied with the settlement or not, and that's where it stands.
Anything you tell us about what's going to happen? What remedies you might seek here? Is there any other guidance you can give us?
That would be inappropriate.
Okay, Brett, let me just close with you on the whole issue of a transaction fee pilot. This is quite controversial. You're in a lawsuit here with the NYSE and several of the other exchanges. You want to propose looking at the way the rebates are done here in the United States. What's your fundamental concern with the way stock rebates are done with the stock exchanges?
First, Bob, I think it's important to point out that we had an equity market structure advisory committee that met for a long time. They considered a lot of issues, and this was probably the principal proposal that came out of that group, that we should look at maker-taker, we should look at the access fee cap, and we should test to see what the right levels are. This is a rule that's been in effect now for over 12 years. Reg NMS now is about 15 years old. It hasn't been revisited once. So what we find is that most people tell us something needs to be done. Everybody has a different idea of what should be done. Our view is that the best way to find out is to test it and to see what the results show and to make policy decisions based on empirical data.
And let me just make a point here, Bob. Technology and trading have changed a lot in the last decade, and it's our responsibility to do retrospective review, to see if the rules that we put in place, a decade ago still work in today's technological environment.